Welcome to the deep dive. Today, we're really digging into the world of gems and jewelry certification, specifically a big player, the International Gemmological Institute, India, LTD, or, well, IGL.
That's right, IGL.
Our goal is basically to figure out where they stand right now, what their growth might look like, and, what factors are really pushing or pulling them.
And we've got some interesting material to work with.
Yeah, we do. We've got an IGL business analysis study guide, something called a new note, which looks pretty detailed, and a report from Nirmal.
A good mix of sources there.
Definitely. And here's something that jumped out at me right away. IGL apparently has a 65% market share in lab-grown diamonds globally.
65%. Yeah, that's a huge number in that specific segment.
It really is. So
Yeah.
let's try to unpack that. What does that kind of dominance mean, and, what's actually driving IGL's performance?
Well, that 65% figure is definitely remarkable. It really sets them up as a major force, not just, another player in the lab-grown space. And to get a better handle on it, let's look at IGL itself. They're known globally as a leading authority for certification.
Okay.
And a really key thing happened recently. Blackstone Group acquired them back in May 2023.
Blackstone. Okay.
Yeah. And as of December 2024, Blackstone holds a pretty hefty stake, 76.6%.
Wow, 76.6%. That's more than just a foothold.
Exactly. And, that kind of ownership usually means serious resources, strategic direction, that sort of thing.
Absolutely. So with Blackstone backing them, how do they stack up against, the competition in the broader certification world?
Good question. So within India specifically, IGL is huge, over 50% market share. They're the biggest independent certifier there.
Over half the market in India. Okay.
Yep. And globally, if you look at all types of certification, they're the second largest independent provider, about 33% market share overall.
Still very significant.
Very, but it's that 65% in the lab-grown diamond or LGD sector that really makes you pause.
Yeah, that number keeps coming back.
It does. And their business covers four main areas: loose natural diamonds, natural diamond jewelry, loose LGDs, and LGD jewelry. That LGD piece is clearly massive for them.
It really sounds like it. Maybe we should back up a step for anyone listening who isn't deep in the diamond world. What exactly are lab-grown diamonds, and why are they shaking things up so much?
Sure. So LGDs, they're essentially identical to natural diamonds. Same chemistry, same physical properties. The big difference, they're made in the lab.
Okay. Created, not mined.
Exactly. And the key impact comes down to price. They offer jewelry quality diamonds, but at a much more accessible price point than mined ones.
Which naturally grabs consumer interest.
Absolutely. That affordability has really fueled interest, and production has, surged in the last few years because of it.
Okay, so if production surged, what did that do to prices? More supply usually means.
Yep, you got it. The increased production did lead to an oversupply situation for a while, and that put downward pressure on LGD prices.
Okay. Prices came down.
They did. But the thinking now, both from analysts and IGL's own management, is that prices are likely to stabilize.
Stabilize? Why?
Well, the idea is there's a basic cost to actually produce these things in a lab, right? So there's a kind of theoretical floor, a point below which prices probably won't drop much further.
Right, a production cost floor. Makes sense.
And interestingly, to handle these price shifts and, crucially, keep that dominant market share, IGL actually cut their certification fees for LGDs.
Oh, they did?
Yeah, by about 18 to 20% back in May, June of 2024. It was a strategic move, really, to stay competitive as the diamond prices themselves adjusted.
That makes a lot of sense. Adjust your service fees to keep the volume flowing when the product price changes. So even with those LGD price issues and fee cuts, how did IGL do financially overall?
Remarkably well, actually. Despite those LGD price corrections, they still pull off around 17% year-over-year revenue growth for the calendar year 2024.
17% growth. That's strong.
It is. And they get it while keeping a really healthy operating margin, about 57%.
Okay, remind us, operating margin is basically.
Yeah, it's the profit they make just from their core business operations certifying gems before interest and taxes, shown as a percentage of their revenue. So 57% is, pretty profitable for their main business.
Very profitable. And cash flow.
Also strong. Their operating cash flow, the actual cash coming in from the business, was INR 393 crore in 2024. Solid number.
Okay, those are definitely robust figures. What about returns for investors? Things like ROE.
Yes, return ratios were impressive too. For CY24, their return on equity ROE was 40%.
40% ROE.
Yeah, Basically, it shows how well they use shareholder investments to make profit. 40% means for every rupee shareholders put in, they generated 40 pays in profit. Very efficient.
And ROCE, return on capital employed.
Even higher, 88%. ROCE looks at profit generated from all capital, equity, and debt included. So yeah, 88% is exceptionally strong. It suggests they're really good at using their overall capital base to generate earnings.
Wow. Okay, so CY24 was strong. Do we have anything more recent, like early 2025?
We do. The first quarter of CY25 showed 10% year-over-year revenue growth.
Okay, 10%. A bit slower than the full year 24.
A bit slower on the revenue line, yes. But what's interesting is their volume growth. The actual number of certificates issued was way up, 26% year-over-year growth in Q1.
26% volume growth, but only 10% revenue growth. How does that work?
It goes back to those certification fee reductions for LGDs we talked about earlier.
Ah, right. Lower price per certificate, even with more certificates, tempers the overall revenue growth. Got it.
Exactly. Looking ahead, management's guidance for the full year CY25 is for revenue growth between 15 and 20%.
Okay, picking back up towards that 17% from last year.
Right. They expect sales growth to kind of catch up with volume growth as the year progresses, and they're aiming to keep those operating margins strong, somewhere in the 57% to 64% range.
So clearly aiming for continued growth, what are they actually doing? What are the strategies to keep this momentum going?
Well, they've got several key initiatives. A big one is expanding globally. The goal is to be the sort of go-to lab for major retailers and brands all over the world.
How are they planning to do that?
They're leveraging a couple of things. One is India's strength in diamond and jewelry manufacturing. The other is their existing presence in key markets like the US, Europe, and China.
Building on existing strengths.
Exactly.
Yeah.
And we're already seeing some positive signs there. Their subsidiaries, like IGI Belgium and the Netherlands, are apparently performing better, probably thanks to better coordination within the whole Blackstone Group structure.
That makes sense, leveraging global connections and India's manufacturing base. What else is in their strategic playbook?
Digital transformation is another major focus.
Ah, the buzzword of the decade. What does it mean for them?
For IGL, it means investing in tech to make their services better, more efficient, and importantly, to cut down the time it takes to get something certified, the turnaround time.
Faster service is always good.
Always. And alongside the tech, they're also physically expanding their labs and hiring more gemmologists. You need the people and the space to handle more volume.
Right, scaling up operations to meet that expected growth. Makes sense.
It's pretty crucial if they want to hit those volume targets.
Okay, let's shift gears a bit and look into the crystal ball. Or maybe just the financial models. We have those future scenarios from the new note base, bull, and bear. Can you walk us through those?
Sure. Let's start with the base case. This is the one they give the highest probability, 50%.
Okay, the most likely scenario.
Kind of, yeah. It projects overall revenue growing at about 16% per year, compounded annually, between CY25 and CY30. That's the CAGR.
16% revenue CAGR.
And it assumes their EBITDA margin, that's another profitability measure, earnings before interest, taxes, depreciation, amortization stays pretty stable, around 62 to 64%.
Stable profitability.
Right. And their PAT margin, profit after tax, is expected to gradually improve, maybe reaching 48% by 2030.
And what does that mean for earnings and valuation?
It translates to an earnings per share, or EPS, CAGR of about 18%. Based on that, and applying a price-to-earnings ratio, a PE of 25, they get a valuation target for CY30 of INR 625 per share.
Okay, INR 625 in the base case. What are the big assumptions behind that?
The key ones are, well, continued demand growth for both natural and lab-grown diamonds, LGD prices staying relatively stable, no big crashes, and IGL basically holding on to its current market share.
Okay, so steady growth, stable prices, maintained share. Got it. Now, what about the bull case, the optimistic view?
Right, the bull case. This one gets a 25% probability. Here, things look, well, quite a bit brighter.
How much brighter?
We're talking a revenue CAGR of 22%, so faster growth, and an even faster EPS CAGR of 25%.
Okay, significantly higher growth rates.
Yeah, and this scenario also sees their EBITDA margin expanding, maybe up to 68% by 2030. Plus, there's potential for the PE multiple itself to increase, maybe to 30 times earnings, reflecting, greater market optimism.
What could drive that kind of outperformance?
The potential catalysts could be things like even faster adoption of lab-grown diamonds than expected, or maybe IGL actually manages to grab more market share from competitors.
And the valuation target in this bull case?
Considerably higher. INR 900 per share by CY30, based on a projected EPS of INR 30.
INR 900. quite a jump from the base case. Now, inevitably, we need to look at the bear case. What's the downside scenario?
The bear case, also given a 25% probability, paints a much slower picture. Here, the revenue TGR drops to just 8%,
Only 8% growth per year.
and the EPS CGR is even lower, just 5%. This scenario sees profitability getting squeezed, with the EBITDA margin potentially falling to 55% by CY30.
Ouch. What kind of valuation does that lead to?
A much lower one. The target here is INR 270 per share. That's based on a CY30 EPS estimate of INR 15 and a lower PE multiple of 18, reflecting the weaker outlook.
And what are the big risks that could trigger this bear case?
The main worries are, first, a really significant and lasting drop in LGD prices, maybe due to continued oversupply or some other market shift. Second, tougher competition, either from existing players getting more aggressive or maybe new ones entering the field. And third, the possibility of unfavorable trade policies or regulations affecting the whole diamond industry.
Right, external factors and competitive pressures. It's good to see those laid out. Now, we also have that external report from Nirmal. What's their take? Are they leaning bull, bear, base?
Nirmal Bang seems pretty positive, actually. They put out a target price of INR 433.
INR 433. How does that compare?
Well, when they issued the report around April 25th, 2025, the market price was INR 349. So their target represented a potential upside of about 27%.
Okay, a decent upside potential. What's their reasoning?
They're using a PE valuation of 30 times their estimated earnings for calendar year 2026. So a bit of a nearer-term forecast than the CY30 targets in the new note.
A 30x multiple is quite high, similar to the bull case PE.
It is. They justify it by pointing to IGIL's strong growth track record and projections, those high profit margins we discussed, and the really attractive return on capital employed. They see it as a high-quality company deserving a premium multiple.
So generally positive vibes from Nirmal, highlighting the company's strengths. Now, if we blend the base, bull, and bear cases from the new note, using their probabilities, what kind of overall target does that give us?
Yeah, the new note did that calculation a probability-weighted price target and comes out to INR 605.
INR 605. So factoring in the likelihood of each scenario, that's the central estimate based on that analysis.
Exactly. It gives you a single number that tries to balance the different potential outcomes. And if you look at the implied annual returns from the time of the note,
Yeah.
the bear case implies losing about 5% per year. The base case suggests a pretty solid 13% per year return, and the bull case points towards a very attractive 20.8% per year.
That really lays out the potential range of outcomes, doesn't it? From losing a bit each year to making quite significant gains. So looking ahead, if we want to track how IGL is actually doing against these possibilities, what are the absolute key things we need to watch?
Okay, top of the list has to be LGD price trends. Big swings there could really impact IGL's numbers.
Right. Stability is key for that base case.
Definitely. Second, keep an eye on volume growth across all four segments: natural loose, natural jewelry, LGD loose, LGD jewelry. That tells you about underlying demand.
Okay. Volume growth. What else?
Market share.
Yeah.
Especially in that competitive LGD space.
Yeah.
Are they holding that 65% or is it changing?
Market share. Got it.
Then, of course, the profitability metrics keep tracking those EBITDA and PAT margins to see if they're staying in that target range or slipping.
Margins, yes.
And finally, you have to watch the bigger picture, any changes in regulations or trade policies that could hit the diamond and jewelry trade globally or in India.
Okay, LGD prices, volume, market share, margins, and trade policies. A good checklist. And just to loop back quickly, that 30% ROE for CY24 we mentioned, that really does highlight the business's current strength, doesn't it?
Oh, absolutely. A 40% return on equity is genuinely strong. It signals that the company is very effectively using the money invested by its shareholders to generate profits. It's a fundamentally positive sign about the business's health right now.
So if we try to wrap this all up, it feels like IGL is in a really powerful position, especially because of its dominance in the fast-growing LGD market.
Yeah, they've definitely capitalized on that shift.
They've got clear plans, strategies in place to keep growing, global expansion, digital, scaling up.
Right. The strategic initiative seems sound.
But they're also operating in a market that's clearly dynamic, maybe even volatile, particularly that LGD segment with its price fluctuations and potential oversupply risks.
Precisely. There's significant opportunity driven by that LGD boom and their market leadership, but there are also undeniable risks tied to pricing, competition, and the broader economy. Examining these different analyses gives us a good sense of that balance.
It really does. We've got a pretty comprehensive picture, I think, from these different sources, understanding where IGL is, the different paths it might take, and what the key drivers and risks look like.
Yeah, blending the internal analysis view with the external financial perspective is helpful.
Absolutely. This has been a really fascinating deep dive. So here's something for you, the listener, to chew on after we finish. We talked about natural diamonds and lab-grown diamonds having potentially very different growth paths ahead. How might IGL need to adapt its whole business strategy long term? To really maximize the opportunity in both while also protecting itself from things like LGD price swings.
That's a great question. How do you balance serving potentially diverging markets?
Exactly. And maybe think about what other factors beyond the financials and market share stuff we discussed could really make or break IGL's success down the road in this global gem market. And definitely some food for thought there. Thanks for joining us on the deep dive.